but it's also maybe a place where you want to go on vacation.
There you go. Yeah. Of course, I'm sure that currency volatility keeping those currency traders busy. But I want to talk a little bit more about, because it's fascinating to see what's going on in Europe, what's going on in France right now, and then to think, okay, we have our own version coming up in just a couple of months in November. Is there anything to extrapolate out of what we're seeing when it comes to political risk volatility in European markets into the U.S. markets when we count down to our own presidential election?
My answer is no. What we have is something very unique. Normally, when you have a president or a potential candidate running against the current president, you really don't know their backdrop. In this case, Trump is a very known entity.
Yes.
So we've been in this situation before. So there's some known knowns. We don't know who is going to get elected. But what we've been telling clients, the election doesn't matter for this year, meaning earnings are on track. Policies that have stimulated our economy through Biden's pieces of legislation, there's over $3 trillion that's been, that has the potential to come into our economy. The Fed's already started to ease. And again, no one's talking about this. You talk about it for a blip, then everybody stops. But on their balance sheet, they've slowed the amount of sales. Actually a form of easing. And then we do have the potential, I've been saying, I think the Fed, if data supports it, which I think it will be able to cut interest rates 25 basis points in September. All of that is very bullish for risk assets. So I think this year we're fine. The question is who gets elected and what does that mean for next year?
All right, Marianne, great to speak with you. Really around the world. Great to see you again. Our thanks, of course, to Marianne Bartels of Sanctuary Wealth. Now, still ahead, we're going to take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this.
Fixed income. Exchanges. Unmatched. The moment news breaks. Welcome to.
Also surging.
And we must hold our elected
strategy
And
an asset classes here.
the top.
That every company needs to intelligent software company.
All right, it's time now for Social Climbers. A look at the stocks waves on social media this morning. And first up, the U.S. Surgeon General is calling for a formal warning to be added to social media sites similar to those placed on cigarette cartons. Now, in an editorial in the New York Times, Vivek Murphy wrote that such a warning would, quote, regularly remind parents and adults that social media has not been proven safe for mental health. Any such move, of course, would need congressional approval. Next up, Adidas is investing allegations of bribery at its China's business after a whistleblower complaint accusing staff of receiving kickbacks from external service providers. The complaint also mentions a senior manager receiving millions of dollars in cash from suppliers, as well as physical items such as real estate. And finally, pull out the popcorn. Disney Pixar's Inside Out 2 reel in the viewers with the biggest box office opening weekend of the year. Now, the animated feature brought in $295 million globally. That is the biggest opening weekend ever for an animated film. It's welcome news, of course, for cinema chains, including AMC, who have been waiting for the next big hit since last year's Barbenheimer success. You can follow all the latest company buzz on TREN on your Bloomberg terminal. Meanwhile, take a quick look at markets at the moment, and again, it's quiet. The S&P 500, you could go ahead and call that unchanged, 0.1% lower. If you take a look at the NASDAQ 100, it's really a similar story, only about 0.1% higher. What's interesting is that volume is actually elevated relative to its 20-day average, but it hasn't exactly translated into big price moves. Now, coming up, best airline in the U.S., according to the Points Guy. We'll speak to Brian Kelly next. This is Bloomberg.
Ago, when I was 30, with my family, American company, being very curious. We're trying to should be the and we believe that work he wants to do.
Your passion.
I think we have been running this company.
Was going to keep
Hollywood.
Well, some good news for travelers at the start of summer, and that's that have moderated and airlines are using discounts to fill a surplus of seats. Bloomberg's Doolittle is taking a look at the travel industry.
Yeah, that certainly is good news for anybody who wants to get on a plane. And we were talking last week, Katie, in particular, those flights midweek, that's where that discounting is. But if we take a look at what's happening on planes, well, especially on long holiday weekends and weekends, the planes are pretty packed. We're planes here in the U.S. Basically just below 3 million per travel throughput. As for some of the stocks related to the travel industry, not surprising. Given the discounting, given the number of people on planes, we're seeing some real strength for the passenger airline index overall, up a very healthy 9%. Royal Caribbean, people are also cruising, up 13%. Viking, this year's IPO, the thinking man's cruise line and river tours, up nearly 30%. And then hotels, not so shabby, up 6.2%. Just here in the U.S., though, if we take a look at what's happening between the U.S. to Western Europe, we are see that scheduled flights between these two areas at 140,000. That's the anticipated number for this summer. That is essentially, it is actually a high 2010. So people are out and about. It seems as though maybe that revenge travel, well, maybe it's picking up some this summer.
All right, Abigail Doolittle, thank you so much for that setup. And let's keep the conversation going with Brian Kelly. He is the founder of The Points Guy. He joins me now in studio. It's great to see you in person.
Thanks for having me, yeah.
So I want to get to your report about the best U.S. airlines, but let's actually talk about discounts. Are you seeing that among the airlines right now?
Absolutely. Last summer, if you wanted to go to Europe, you were spending $5,000 to $8,000 business class. You know, those frequent flyer mile tickets last summer were 400,000 or 500,000, 600,000 miles round trip. This summer, there's a phenomenon going on. I mean, Air France has 50,000 mile business class seats from a lot of the U.S. gateways all throughout the summer, even throughout the Olympics. So because of that increase in supply, we're actually seeing decent fares. You know, I'm going to Ibiza in August, and it's $4,000 first class.
Wow.
Which is like half of what it was last summer. So, you know, I always tell people, before you buy a ticket, use Google Flights. You know, switching by even a single day can drop the price dramatically, and always double check to make sure that there is frequent flyer mile availability.
And so let's talk about why that's happening. I mean, is that just really the airlines reaching the end of their pricing powers, consumers getting a little fed up with prices and choosing not to travel, or are they adding more capacity, or what is actually behind that?
It's interesting. I think since the pandemic, business travel hasn't quite bounced back as much as leisure travel. So leisure travelers are now actually spending. So a decade ago, you know, Delta was giving away 80% of the first class cabin to status upgrades and selling 20%. That's now inverted. So throughout the pandemic, when prices were much lower, you know, premium consumers got used to paying little by little. It's kind of like they were slowly boiling the water, and now people are used to getting that premium experience. So there are now more leisure passengers willing to pay the $4,000 or $5,000 than when they were trying to just fleece that business traveler whose company had to pay $12,000. So the pricing models have changed, and I do think overall it is good for consumers.
Yeah, and it's interesting, of course, to hear that adaptations that have to come with the pricing strategies. Let's talk about the report that you recently put out, though, your best U.S. airlines for 2024, and Delta with another clean sweep for the straight year, getting that top performing spot. But what was interesting to me is that its lowest performing area was affordability, which I would think would be a
big factor. You know, at the Points Guy, everyone has their favorite airline. If you're in New York, like where you're closest to, but we wanted to look at the data sets. So we had four main categories. The biggest reliability. That was 30% of the score, because at the end of the day, when you get a flight, you need to get to where you're going. And Delta is the on-time airline in America, so it definitely helped there. Also in reliability, we looked at airlines that are now losing wheelchairs, which is a really terrible problem that keeps getting worse. So we ding those airlines that don't have great policies. Funny enough, Allegiant came in #1 in overall in reliability. Delta didn't win in any one of those categories, but they were super strong across the board. But we also looked at loyalty, customer-friendly policies, like family seating, which Delta did do very well in. So we wanted to take a holistic approach, but that Points Guy spin with the loyalty factored in.
And there you go. What's really stood out to me is that you take a look at some of the low-cost carriers, Spirit, Frontier, for example. They actually lost standing in this one.
They did, and I do think we also looked at route network, right? Points Guy reader is global. They want lounges. So I do think our survey is somewhat never going to have Spirit be #1, you know, especially because loyalty is 25%. Those low-cost carriers do not have loyalty programs. So I don't want to say they're not great airlines. They serve a population. They serve routes that are so they are good in certain ways. But when we look at the Points Guy, like, you know, the global airlines that are serving passengers, you know, we wanted to come up with our best recommendations. When people have an ability to choose at the same price, we kind of want to give people the data to show, well, you might want to choose a carrier that's more reliable.
Well, say never. Something
you never say never. You're right.
Could happen, and Spirit could get
come
the
up
top
from behind.
spot.
I've seen crazier things.
Let's talk about some of the airlines that did make big gains, however, because it stood out to me. Alaska, for example, with the biggest gain. And of course, it feels like most of the recent coverage on Alaska has been dedicated to its January issue with that Boeing plane. But it seems like that actually hasn't dented its performance.
And these numbers are based on 2023 data. So that incident from 2024 wouldn't be reflected. But, United, the biggest jump this year or drop, United from 2 to 3, and I do think last year they had their operational meltdown, but they also had some max groundings. And also the biggest issue, United's been hit the most on airplane deliveries. They just simply, every airline in the world now is dealing, both Boeing and Airbus are way behind on deliveries, which is impacting, route expansion and reliability.
So there you go. So airlines still coping with those Boeing issues.
Yeah.
Growing pains, there you have it. Let's talk about driving versus flying, though, because, of course, we're talking about airfares. We're talking about people paying up for those more premium experiences they've gotten used to. But when it comes to people actually getting in their car, it seems like that's also very popular.
Booming, yeah. Gas prices have leveled out, so it's much cheaper. I mean, it depends, actually. But, yeah, I mean, Americans are the roads in mass, are hitting the airports. And I do just want to say driving, the traffic is crazy these days. So even though the TSA can handle that record number, 2.9 million, the roads can't. I nearly missed a flight to JFK. So for anyone at home watching, those travel procrastinators who try to get there, 1 hour prior, please check in advance. Because even if you show up late, at least if you're checked in online, they might let you slip through. But, New York, LA, traffic, I just recommend this summer at least add in an extra hour to get to the airport.
Extra hour, certainly.
Or just take the Blade helicopter, yeah.
Yeah, there you go. Yeah, there's alternative methods for getting there. And when you think about sort of the psychology of the industry right now, of course, we heard Abigail mention revenge travel, and that certainly seemed to be fueling some of the numbers we were seeing for at least the past couple years. But where are we in the narrative? Is it safe to say we're firmly out of the pandemic mindset and what came after it and in a new era, or would you still phrase what we're seeing as sort of that revenge travel?
No, I definitely think we're post-revenge. We're post-COVID. The last several summers, I was on, shows like this, just talking nonstop about the meltdowns, the staffing shortages, the baggage delays at Heathrow, images of 10,000 bags. The airlines have gotten their operations under order. It's somewhat smooth sailing. I do think we are, reaching a new normal where airfare, there is more capacity. The world's opening up. Asia is still not where it was. We're still, kind of growing there. Business travel, a little bit lower, but that leisure travel is back. And I just think when you look at the demographics of all younger generations who value experiences and travel over things, I think, the overall outlook for the travel industry is very bright.
And before I let you go, let's meditate a little bit longer when it comes to business travel. Like you said, it's not quite back. And is that just the new reality? Are we ever going to see those 2019 when it comes to business travel?
Never say never. I do think, clearly Zoom and, companies are being smarter about spend, especially with the easy economic outlook, inflation. A lot of companies are getting hit for cost. So there still is that cost cutting that's going on at a lot of companies where they're saying, do we need to have this 400-person meeting in Vegas? Yes, it's a nice to have, but it's really. So I do think it'll continue to grow, but TBD on if it ever kind of surpasses where it was.
All right, Brian Kelly, it's always great to see you. Really appreciate your time. Have a great week. That is Brian Kelly. He is the founder of The Points Guy. And let's get a check on these markets about an hour into the U.S. trading day. I'm going to do that with Abigail Doolittle.
So we've just had the S&P 500 flip ever so slightly higher, actually onto. It was up just moments ago from a decline down slightly on Friday, and there it is going back down. But you can see a firmer line for the Russell 2000. Small cap stocks continue to be under pressure, really performing over the recent time period. In terms of what's happening for the S&P 500, beneath the surface, a real battle in the big tech names. Apple up 1.7%, really trying to support last week's or at least surprising to me, breakout. We'll be taking a look at those charts later this week and probably ahead in terms of what is actually going on there between the bulls and the bears. And then NVIDIA, a rare down around about 0.75%. This is the top point boost and the worst stock from a point for the S&P 500. And again, helping to explain why we're having this little tug of pull. As for the dollar, it's interesting. The dollar's been in a bit of a stealth rally, Katie. If we go into the Bloomberg terminal and take a look at here, we are going to see back in April, this was the year's high out of last year. a pretty solid rally. It's interesting because we have stocks higher with this. This is an ideal situation. It suggests a strong dollar signals a strong economy, and the stock market going along for the ride strong also. We're more used to, I would argue, a situation when the dollar is strong that can pressure risk assets. It's not happening right now, at least, but you can see the dollar going back up to the highs of this year. One question: if we do continue to see the dollar go higher from here, will that pressure risk assets? Stay tuned. As for what's behind the dollar strength, or it's hard to know, sort of a circular relationship here, but at least on the take a look at yields, the 2-year yield closer to 4.75. Of course, supports the dollar going higher.
All right, Bloomberg's Abigail Doodle, thank you so much. Now, coming up, we're going to take a look at demand for AI and what that spells for data centers. Wes Cummins, he is Applied Digital Chairman and CEO. He joins us next in today's Wall Street Week. This is Bloomberg.
Former New York Yankee about business. And across my career, the deal. Across sports.
What was going to be, I put everything I... you know what I'm saying?
And huge.
Bloomberg brings you a Bloomberg second largest deflationary show brings you the unmatched, the most influential newsman. Hong Kong time, right?
All right, it's time now for our daily Wall Street Week conversation, and the rise of AI is posing challenges to data centers. Applied Digital, which designs, develops, and operates data centers, is looking at how to adapt its infrastructure. Wes Cummins, he is the company's founder, chairman, and CEO. He joins us now alongside Wall Street Week's David Weston. And data centers, I mean, it's one of the hottest topics out there.
It really is. Every day we're talking about data centers somehow, some way. But Weston, thanks so much for joining. Normally, when Katie and I talk with people about data centers, it tends to be the commercial real estate side of it and investing in it. We actually develop these things and actually install and operate them. So give us a sense of what's the big deal with data centers now that didn't exist before the rush to AI? We've had them around for some time, right?
David, I think that the key to understand, the primary thing to understand is the difference in the compute workload that's going into data centers now versus what it was in the past. So in the past, we were building data centers that were in population centers that were providing low latency communications so that we could get YouTube, so that we could get Netflix, so we could get TikTok. You get all of our things that have been driven mostly by video applications. Now, as we're moving from applications that need ultra-low latency communications outside the data center to applications that need massive amounts of compute. So think of it, doing large math problems, algorithms. This is what AI is doing inside the data center. Compute equals power. And then inside the data centers, you need a lot of compute close together. So you need really high power density. And so these are kind of some but historically data centers were, let's call it 7 kilowatts for an entire rack of computing. An NVIDIA H100 server, one by itself takes 10 kilowatts. And so then you need to stack all of these together. So you have a massive amount of power consumption that needs to be close together. The latency inside the data center now versus outside needs to be ultra low. And so you have to build a completely different of data center. You need large amounts of power in the same location. And so that's what we're doing. We find large amounts of power, typically different locations than you would do city center. So it's no longer New York or Virginia or Dallas or Los Angeles. We're building in different locations where we use a lot of renewable energy that have the hundreds of megawatts, if not gigawatt of power, so that you can, run these workloads. Just very different style workloads versus what we're used to.
Right. And when it comes to that adaptation process, really sort of converting those existing data centers to be able to handle the AI workload that people are trying to do, I mean, how long of a process is that? How long is that timeline?
So I'm a big believer that you're better doing greenfield in that you just build entirely new style of data center versus trying to retrofit. Cooling is different. Again, power density is significantly different. So there's a big issue. So the number one issue right now is finding power. Where's near-term power? We have a very unique way of finding power, which is we find things that are called stranded power, and we typically use a lot of renewable energy more in the middle of the country. So number one is power, and then number two is supply chain. So the electrical components, it's just, it's transformers, it's chillers, it's high voltage switchgear. So supply chain, because of the demand for this, has become really stretched as well. So number one is power, and number two, supply chain.
So Wes, are you building your own power? I mean, you're building those wind farms or solar or even nuclear power, or are you tapping into some other part of the grid? And similarly on the supply chain side, how long is the lag on all this? It sounds like it's going to take an awful lot of time to build that power and also come up with all that supply chain.
So right now we're not building the power. That's something for the future for us. So there's a unique setup in North America that we take advantage of. What I call it is stranded power. So there's power that is generated and not used. And I know a lot of people would think that if you can generate an electron anywhere in the U.S., used anywhere else in the U.S., and that's just not the case. You need the transmission infrastructure to actually be able to do that. So we find places where, for Ellendale, North Dakota, for example, there's a massive amount of wind power that feeds into a substation, and oftentimes they have to curtail the wind because there's not enough demand, there's not enough load to use the power that's generated. So we go to that location, and we have several of these locations where we use power that's currently not being used. Now, to go to the other part of your question is for new power. So you can build power gen renewables over, let's call it a 24, maybe 36-month time frame. The bigger issue is transmission. So transmission to transmit that power that typically is built, somewhere in the middle of the country to end users, that's more of a 10 to 13-year process. And so we're kind of shortcutting that by taking these workloads directly to the point of generation.
I want to talk about the competitive landscape here. As you think about AI, and it's just really made its way into every part of the market. It's every investor in every asset class is trying to figure out what's the AI narrative in their industry. Think about your own industry and data centers right now. How fierce is the competition?
So it's an interesting time for sure. So if you go back a year ago, everyone was trying to figure out data center side, what's happening in this market, right? Why is all of this demand? Why for the high power density? Now, in this industry, we figured it out, and now it's trying to make this solution. Because again, getting the amount of power that's needed and operating these style of data centers is extremely difficult. And so think of on the data center side, right, we're the shovels. This is digital infrastructure. This is the digital infrastructure that was built out to run everything that everyone's used to running on their phone or on their TV at home. And now it has to be rebuilt. It's not a replacement, by the way. This is an add-on, but rebuilt for compute and AI workloads. So we're the building blocks. We're the infrastructure that runs all the AI that everyone wants to do. And we're talking. Everyone knows ChatGPT, but if we're doing anything in video, visual, anything generative AI runs on this infrastructure, and a massive amount of this infrastructure needs to. When Jensen at NVIDIA talks about AI factories, so what we've done, we actually designed our data center in partnership with NVIDIA. We work with their team to build the style of that we're doing, because this is the issue in the data center industry. Is it's just a very different style from data centers that were done in the past, but we're running all AI workloads, and these are really split between training and inference, are the terms that are used in AI, but the industry is, I would call it, scrambling to build the amount of infrastructure that's needed to house compute to run these applications.
Well, so it wasn't that long ago we hadn't even heard about all these data centers. What prevent obsolescence?
So that's a great question. So when we build our facilities, we think about what we call future proofing, right? So we think the power density goes higher, cooling. But I think the last 20, 30 years were again really driven by applications that required, I call it comms, high-speed communications. And as we go for the next 20 or 30 years, applications are really going to be driven by compute, and that's what AI is. And so we're working to future-proof. And by the way, the older style data centers, those are not obsolete. We still need all of that capacity for the applications that we continue to use. This is absolutely a complete add-on to what's been done in the past. And so, but trying to not be obsolete is making sure that you're future-proofing your facilities as much as possible with power density, with cooling. We're trying to run it extremely high efficiency so that we lower our carbon footprint. We build where there are renewable. Right. We mostly use renewable resources, but those are the things you try to do. Obviously, not obsolete in the world is one of the keys here.
All right, future-proofing, that's a good place to leave it. Really enjoyed this conversation. Our thanks to Wes Cummins. He is Applied Digital co-founder, chairman, and CEO. And David, who else do we have coming up?
Tomorrow we're going to make a big turn. We're going to talk about carried interest with Ludovic Philippou, who is a professor at Oxford, has a new study out, and it will get your attention, Katie, how much money private equity is making out of that special tax treatment called carried interest.
I'm sure there are some big numbers involved there. Looking forward to that conversation. Our thanks, of course, to David Weston. This is Bloomberg.
Agenda. Bloomberg at 5 a.m. Eastern. Politics. Host Joe Matthew and his power player.
Ugly year.
Balance. Only on Bloomberg TV. Covers the latest. Farrell, Lisa. Everything.
All right, let's take a look at these equity markets. We are about 90 minutes into this Monday, and boy, it is boring. You take a look at the S&P 500, nothing going on, unchanged right now. Maybe we'll get some more action when we get that retail sales data. Of course, a very important insight into the consumer. A little bit more to talk about if you take a look at the NASDAQ 100. That's your leader today with just 0.1% gain. Big tech breaking out on a relative basis at least. And interesting, actually, the Philadelphia Semiconductor Index not doing too much, down about 0.2%. Of course, that has been the hot area in the market, but not so much today. Now coming up, we have Bloomberg Technology with Caroline Hyde and Ed Ludlow. But that does it for Bloomberg Markets. I'm Katie Greifeld, and this is Bloomberg.
I understand you have off.
So I run Saturday is typically by playing tennis with have a nice lunch, and then I try to I would send all get I think what we do is so that if you're always on or narrow, the leader than I am. I believe I'm a much better
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York. Ed Ludlow is off. This is Bloomberg Technology. Full market coverage ahead as the Magnificent Seven see a momentum
like never before. Plus, we push ahead to GameStop's AGM as CEO Ryan Cohen gears up for remarks. And we take a look at the summer box office as Inside Out 2 rakes in over $150 over the weekend. But first, let's check in on those markets because we are seeing some pause, shall we say. We are looking at what the Federal Reserve comments are going to be this week. Our policy, yes, last week, of course, signaled maybe, are we going to get the rate cuts that the market is anticipating? Notably, is the political tension still happening over in Europe? 10-year yield just actually selling off significantly after there was this push for havens last week. That calms a little. Why does it calm? Because Marine Le Pen over in France, right-wing, of course, person that we could see become prime minister if indeed we do see this, well, this legislative vote go her direction. She's trying to calm the market, trying to calm the broader French population to say she would be still backing institutions and she'd support Macron if she did indeed become minister while he was president. CAC 40 sees some relief. We're up 0.9%. Move on and see what's happening on the individual moves today because we are seeing a little bit of movement on what's happening in the chip sector. Now, the stock previously at a record high. We dial back from that as NVIDIA indeed sinks. $130 is where we currently trade. We're getting big calls from some big investors and analysts still saying, look, we could go as high as $160. So pointing us in that direction, but we just perhaps take profits as we hit a new record high. Micron, though, up another 2%. Analysts upgrade their price target on this particular stock. Broadcom also winning as we look towards that stock split. Follow hot on the heels of NVIDIA. 1,798 is where we trade. But look, we have seen these particular chip names do phenomenally well over the course of this year. And many are saying this is momentum strategy that's winning. Basically, what do? You buy the winners and you sell the laggards. It's kind of a powerful force in the markets, but right now it has gone a complete tear on a scale that we've never seen before. Break it all down with Bloomberg's Isabel Lee, and there's a great bit of reporting coming from Bloomberg across our outlets talking about how much this momentum trade can stick because it's working.
Yes, it's definitely working on a scale never seen before. The relative performance has surpassed that of the dot-com bubble, which was in 2000, so it's around 24 years. And it's really simple. You buy what's winning, you sell what's losing. But the question is, will it last? And momentum has a tendency to go on and on until something stops it. Worth noting, though, that this stretch has been going on for a while, longer than usual. But what's concerning is how the driving force is really mostly valuations. It's not anything about momentum, about earnings. So this is why some people are worried that it might buckle anytime now. But then just anything, this is the winning trade. There will always be losing trade, and the losing one is value. But of course, if you're invested in momentum and tracking momentum, it's a great year so far. In the strategies that Bloomberg tracks, there are 13, and top of the list, momentum, 16%.
It's interesting that you say some of the worry is about whether it's on valuation, whether it's on earnings. Now, some would say NVIDIA's earnings increases do vindicate the valuation uptake, but is it just breadth? Is it some of the other names that are getting swept in on this that are moving more on valuation than actual earnings guidance?
That's fair. I mean, I think NVIDIA, every time I ask about NVIDIA, I do get bulls and bears. So it's like there's even consensus. But the thing about this AI rally is the big winners are getting bigger, and obviously everyone is left behind. I mean, you take a look at Apple. Apple last week saw one of its best week in years just because of one announcement. And the thing is, it's interesting that these announcements wouldn't even roll out in the near future. So how will we test whether they will work? But then for the longest time, Microsoft's lead against Apple seemed far. But now Apple is inching towards Microsoft just because of that one announcement of an AI chat GPT-like integration, basically to compete with Microsoft. So that's the thing. The play is so narrow, and whether the momentum trade will last remains to be seen. Is AI really going to be a transformative technology that will drive profits and productivity, or is it just going to give some companies a handful of cash for the meantime?
Well, I'm sure the companies are liking the handful of the cash for the time being, and indeed the investors the bit on the winner. Isabel Lee breaking it all down. Let's talk about what could be the catalyst that puts it to an end. Pleased to welcome Megan Horniman to the show. Capital Advisors CIO. And to that point, this has been a runaway trade, the momentum trade. What could stop it?
So, you mentioned it's a momentum trade. So to be able to figure out exactly what will stop it, it's basically impossible. But we think that there's a things to keep in mind. The interest rates right now, we did get that flight to quality last week, so yields went. Markets like that. But then take a look at what's happening today. Yields are backing up. That can this momentum out of this rally, because what's going to happen is people will just start looking at valuations and the uncertainty around where interest rates are going. We obviously know that eventually the Fed will cut rates. We don't know when. And when you're looking at long-term yields, when you're looking at the Treasury market, the dynamics market are just for higher yields because we have so much issuance that's out there. And this, we think, could take some wind out of this sail here. It's just it can be a valuation correction.
Really interesting that you're looking at what's happening in terms of supply side with treasuries. Well, what about the inflation picture? What have you been taking from the PPI, the CPI, and whether or not we are cooling or whether actually we're still too high for too long?
It is cooling. The data we got last week was good. Let's keep in mind, it was 1 month's data, and we still are a far way away from where the Fed wants to be. To actually dig into some of those reports, this is a goods deflation story. This isn't a service deflation story. In fact, we're still looking at service prices that are quite sticky, and housing as well is another sticky. These are things that the Fed is going to be taking into consideration. This is why we think, and we kind of the camp higher for a little bit longer. We might get something in December, but we need a lot more information where we can say that the Fed can do that.
And just add in, as you say, that flight to quality, that volatility that we see because of political risk over in France, of all places. I mean, how much, Megan, do you have to take in the global political risks right now?
I think it's something we have to consider. When you're coming into this year, we knew we have elections and political risks globally. And let's keep in mind, we still haven't gotten to November. Here in the U.S. So there's a lot from a political standpoint through the summer that can keep the markets on edge. And it just tends to be when there's so much risk out there, but the markets are so high, upside risk from here. That's what I don't see. I see a lot more downside risks from here than I do upside catalysts.
So what to do as a chief investment officer of Fed's Capital Advisor? I mean, where do you see, is it protecting your downside, or is it hedging, or is it more sort of reallocating in some way?
So at this point, there's, cash. Keep a good amount of dry powder that you can take advantage of opportunities. That's what we've been doing. Cash isn't hurting you right now. You're getting 5% or more. Eventually, that will be the case. But for now, you have the cash to be able to look for opportunities. And there will be opportunities. Right now, if you look at the market, parts of the market that are really unloved, look at small and mid-cap stocks. Now, the economy starts to roll over. They're going to struggle a bit, but that's the time to take advantage because that's where you see the best upside as we get out of this, an economic slowdown. And they're priced on a relative basis versus large cap, the cheapest we've ever seen.
When you're thinking of a technology show such as ours, and many want to understand the realities, you need to be diversified. They also want to understand where the opportunities are outside of Mag 7 in technology. Like, is there a play for tech, indeed AI, in small and medium-sized companies?
So, the AI is here with us. It's been here, but it's just only going to evolve going forward. The one thing when you think about AI is it's not just technology, and I know it's a technology show, so I apologize, but let's look at other areas of the market that will benefit from AI. So what are the companies and sectors that are going to benefit implementing AI, that we can see that in their earnings? Those are some of the things that we're looking at. Industrial is an idea. Some consumer stocks, I think it's right now a little bit cautious. The economy is weakening and consumers are definitely stretched. But think of where the companies that are going to benefit from use of AI going forward.
What about energy? I mean, there's a great story, very well read, all the focus of Bill Gates at the moment, perhaps on nuclear energy. And I'm wondering whether you're seeing energy and some of the infrastructure needed for this new AI paradigm shift as a place to bet.
Yeah, absolutely. It's an area, look at what utilities have been doing as well because of the use for it. But the infrastructure side won't have yet to be able to support what this AI is going to look like in the next decade. So we do need an infrastructure standpoint. Those are some areas that we'll look at as well as we see some weakness in this market.
It's great to get a take that encapsulates a lot of tech, but also to diversify outside and around it. Megan Honeman, we really appreciate it. Verdant's Capital Advisors. Stay well. Meanwhile, coming up, look, there's been a meme frenzy, and GameStop's annual meeting actually kicks off today after it's postponed due to technical issues, due to that meme demand last week. For details, that's coming up ahead. Meanwhile, look, keep an eye on shares of TSMC. We look at what happens in terms of trading of ADRs, which actually there is a trade here. There is a long-favored arbitrage strategy where you buy TSMC over in Taipei and you short the US ADRs, American Depository listed here, but it's becoming painful because basically the premium of the US is pushing ever higher. Will we see it around. This is Bloomberg Technology.
CFO. Dynamically
of leading beyond the number.
And push people.
On the balance sheet.
Culture today than I talk.
It's a lot more.
Even more from the new episodes this summer. Bloom in 120 countries. Context change.
Let's talk EVs. Ferrari will release first fully electric model next year, but is open to a range of technologies. That's all according to the company's CEO. Now, younger buyers favour electric, but established customers, well, they're hesitant to give up the sports car's trademark roar. Ferrari aims to offer traditional, hybrid and electric options to satisfy all of its customers. And let's talk a little bit more along the electric vehicle route, because Tesla has gotten approval to test its advanced driver assistance system over on Shanghai streets. Bloomberg's Craig Trudell joins us now. And how important is FSD? How important is this for the Tesla business model?
It's an incremental step, and I do think that there's some potential for what Tesla markets as full self-driving to be a more meaningful contributor to their business in China, which they could really at the moment. But what we don't know is just how long it's going to take them to be able to offer this widely. Even this incremental step that we're reporting on today really just applies to the city of Shanghai and potentially also Hangzhou, another city. And so we're not necessarily seeing China take the same sort of hands-off approach that we've seen in the U.S., where they've been able to offer FSD nationwide, and it wasn't all that trouble for them to make this available to consumers. On the other hand, in China, they're really going to have to sort of, in piecemeal fashion, hit the sort of tick the boxes that they need to with regulators in order for consumers to be able to activate this.
And it feels as though Musk has realized that he needed these green lights coming from regulators. He made whistle-stop tours to Beijing, and actually, therefore, having to play alongside all the other Chinese EV makers.
And this has been, months in the making, even before that recent trip to Beijing that you mentioned. This is a case of Tesla having, offered the ability to buy this if you're a customer in China, but, not being able to actually activate it and be deployed. The sort of ability to turn this on. And so, I think there's still a lot of questions about, just how willing Tesla is to continue to charge as much as it has for this system. Depending on, how much sort of capability it's able to offer, because this is all going to be up to the regulators. And again, I think they're going to, the likelihood that they're going to be as permissive as the U.S. has been, where Washington has taken this view that we don't want to stay away. We want to offer, driver assistance systems, plenty of leash to try and, offer, the sort of safety benefits without, getting in the way. That remains very much an open question.
Craig Trudell, we thank you so much. All things Tesla. Now, Tesla has a pretty loyal shareholder following. So too does GameStop. So loyal that they're going to have to reschedule their annual meeting. It kicks off today, 12:30 p.m. local here in New York, Eastern Time. It was delayed last time because of technical issues. We're going to break down why with Bailey Lipschultz. And it was because too many people wanted to log in all at the same time, right?
Too many people trying to get in. Computershare saying that they had to reschedule it from Thursday afternoon. Again, to your point, to 12:30 today. We had to resort to Twitch streams, YouTube streams, which was interesting because there were tens of thousands of people flocking to these channels that normally get maybe a half dozen people checking in on a daily basis. So people trying to find a way to stream it. So fingers crossed it goes off without any glitches today.
Is there so much demand? I mean, who are we going to be hearing from? What are we going to be knowing?
No one knows. So when you look at last year's AGM, when Ryan Cohen, it was the first time as chairman leading this call, he spoke for about 90 seconds. The entire call. 90 seconds. 90 seconds.
Okay,
the entire call lasted about 15 from start to finish. So no one knows what's going to happen. There's so much interest in whether Roaring Kitty Keith Gill could appear or be mentioned in any way, shape, or form. The company did raise about $3 billion through sales of shares over the last 2 months. So will they address the cash haul that they have now, about $4 billion in the balance sheet? Will they address the strategy? No one really knows, and I think that's part of the reason that people have to tune in, because if Ryan appears, how long does he speak? Does someone else make a guest appearance, or is it strictly business from some of the lawyers?
I tuned into Keith Gill's own YouTube channel the other week. It doesn't seem like he knows much about the strategy of GameStop either, but he does seem to be moving around his holdings. He's changing his options, actual share ownership. That seemed to be pushing up the stock recently.
Yeah, there was some excitement around that. We saw about a week and a half ago, he posted a screenshot on Reddit, 5 million share stake, 120,000 call options. A couple days later, turned out he exited that call positions and reported north of 9 million shares. So that makes him a top 4 holder if we take it at face value, and is on paper worth, the last time he posted, about $62 million. So where did he get the cash from? How rich is he? A lot of questions and uncertainty on that he never addressed on his stream, but nonetheless, again, if you take it at face value, what he posted on Reddit, top 4 holder, retail shareholder who back in 2020 was preaching GameStop, the Ryan Cohen vision, and squeezes.
And let's just focus for a minute on Ryan Cohen, because if you haven't been a complete GameStop fanatic of story or into the stock, why do we care so much about this individual?
Co-founder of Chewy, so a lot of people bet against that, said they would be Pets.com 2.0. Very successful sale to PetSmart, ultimately went public when he was no longer associated with the company, made a pretty nice fortune from that. He took an activist stake back in 2020 in GameStop, then pushed and really helped trigger alongside Keith Gill in early 2021, getting seats on the board, pushing for changes, ultimately ousting pretty much the entire management team, and now is the chairman, CEO, president of the company. And really the whole belief in GameStop with Keith Gill's is that Ryan Cohen will be able to turn the company from a brick and mortar company that has shown slowing sales, has shown a need to close some of those stores, and completely revamp the business. The question is, what does that look like? How do we get there? No one really knows, but that's the whole kind of group mentality behind the GameStop, the retail investors who really like the stock, is that Ryan Cohen knows. He won't tell us, but at some point this is up working out, and that's really been why we've seen such a wild ride over the last 3 years. And you have to at some point tip your hat, though, because Ryan Cohen in RC Ventures owns about 8.5% of the company, so he put his money where his mouth is.
And he's put some money in the balance sheet of GameStop too, and that's Citron, for example, has just exited at short. Always great to get Bailey Lipschultz on all of the backstory when it comes to GameStop. Tune in at 12:30 local. Meanwhile, coming up, Google DeepMind. Well, it shifts from a research lab to an AI product factory. Or at least it tries to. We're going to talk about the move and if it's undermining its running strength in foundational research. That's next. Meanwhile, just keep an eye on some of these stocks, because AMD has been under pressure all day. It seems as though the rest of the benchmark is kind of playing catch up to it. No real news around other than some new AI 9300 series CPUs won't be offering like Copilot Plus features at launch. That's being reported by other outlets at the moment. But we keep an eye on down more than 2%. This is Bloomberg Technology.
Come fix. Just everything.
You need to have an AI game. Now we say that every company.
The top names in
sponsors are just going to have to hold, and returns are going to be lower.
We used to have high price. Vintages have done actually.
That was going to of Hollywood.
Google, which has long been a pioneer in new technologies like AI, but has just watched rivals like OpenAI harness its research and seem to leap in the world of generative artificial intelligence. So the company is reorganized. Originally, Google had two separate AI labs, Google Brain, where researchers kind of pursued passion projects with some loose oversight, and the acquired DeepMind, co-founded by AI luminary Demis Hassabis, who had this to say about the future of AI development.
I think AI is overhyped in the short term and probably underestimated over the long term, like what it's going to bring. And I think that's probably true of a lot of breakthrough technologies. So I think we're seeing, because of the popularity of AI now in the last couple of years, lots of people trying to get into this space who maybe haven't thought about this as long as people like us who've been in it for decades. And I think we're going to see a sort of rationalization process happening.
Indeed, that rationalization process is upon us with a combination of Google's two AI labs in 2023 into a super unit, Google DeepMind. Look, it was to commercialize products and keep pace with competitors, but several employees are saying this has been undermining the company's edge in foundational research. It's a great story written by Mark Bergen. We want more on this because is there a tension internally after these 1 year down of an amalgamation?
Yeah, I mean, to be clear, it's Google. There's always a tension internally. It's a big, messy company. I think what our story does, I think kind of unfolds here is that, like, part of it is, for Google, right, DeepMind has historically has been London-based. Google is out of its headquarters in Mountain View. You've had these sort of competing labs that in some ways operated very differently. DeepMind has, for the past decade, basically an incredibly well-funded research operation and doing some cutting-edge AI, probably the world's most cutting-edge AI, is not always connected to Google services, Google profits, its commercial center. Now they're attempting to, I think, swing much more in a focus on products, to be, Gemini being the flagship one, competing with OpenAI model. I think there's still a lot of bumps and warts and all in that merger. And there's always a conflict between how much is sort of doing these sort of core products versus more exploratory research.
Talking of bumps and warts and all, look, the commercialization hasn't gone that smoothly, and that is kind of the problem of being such a big company where they can't act like a startup all the time.
Yeah, I think so. Although, you'd think that clearly Google is under much more scrutiny around for the kind of mess ups that they have, right? The Gemini ones, which we've talked about. And I think that's totally understandable given just how big of their services are, right? Like how many people are using Google search on a daily basis, and how much responsibility that has, not just for their bottom line, but obviously like the regulatory they're under, and internally, I think that those those screw ups that they've had. I think there's going to be some interesting tension about what changes they make when they launch. They clearly have been screwed and criticized for a long time, particularly from internally for moving too slowly. And I think OpenAI and Microsoft push Google to move pretty fast. And you could say that some of these pretty public snafus with Gemini might be a consequence of that.
Demis, of course, seeing AlphaFold and medical applications, a real business model, but we see how Gemini continues to evolve as well. It's a great story. Go read it. Mark Bergen, a deep dive on goings on at the top when it comes to AI labs becoming one over at Google.